It's my great honour to introduce this event, the address by Professor Stephen Zeff on the future of the International Accounting Standards Board and financial reporting. This is actually the second in our series of lectures commemorating Tony Dale, the XRB's chief executive from its inception in 2011 until his untimely death in April 2015. It's an absolute pleasure to have Tony's wife and daughter Ashley with us today. Welcome. It's always very special for us to have members of the family at these special events in what is now our annual calendar. Last year we were privileged to have Professor Arnold Schilder, the chairman of the International Audit and Assurance Standards Board, and he delivered the inaugural Tony Dale Memorial Lecture. This year, we continue to maintain a very high standard of international speakers who agree to assist us in acknowledging Tony's contribution to the accounting profession in New Zealand, and in particular to the setting of accounting and auditing standards. And it's wonderful to be able to welcome Professor Stephen Zeff back to New Zealand. Stephen is a regular visitor and speaker in New Zealand. He has taught at Rice University, Texas since 1978, and he's lectured in over 55 countries. He holds Bachelor of Science and Masters of Science degrees from the University of Colorado and MBA and PhD degrees from the University of Michigan. In 2011, the International Federation of Accountants presented him with the inaugural IFAC International Gold Service Award. And he's in New Zealand as the Professor Don Trow Visiting Fellow at Victoria University of Wellington from the 24th of September to the 23rd of October. I would like to acknowledge Victoria University of Wellington in allowing us to utilize Stephen to present to us this evening while he's in New Zealand. And it's an additional bonus and wonderful to see Don Trow in the audience somewhere. Thank you, Don. It's wonderful to see you here. So please join with me now in welcoming Stephen to address us. His topic is the future of the International Accounting Standards Board and financial reporting. Stephen.
Thank you, Graham, for that very nice introduction. It's a pleasure to be giving the second annual Tony Dale Memorial Lecture, and the topic I have chosen, as you can see from the screen, is the future of the IASB and financial reporting. The IASB has now been around 15 years. To some people, it seemed longer. And it built on the IASB, the International Accounting Standards Committee, that had been in operation from 1973 to 2000, replaced by the IASB, now a full-time body with a very large staff based in London. I'll make some remarks about some of the issues facing that body right now. And then with respect to financial reporting, possibly a better term would be company reporting or entity reporting, because the last 20 or 25 years have been a period of grand experiment in non-financial reporting in particular, as well as to some degree financial reporting. And so instead of saying financial reporting to investors and shareholders, as many people say, today it's more likely people will talk about company or entity reporting to stakeholders. Two differences. One, financial reporting becoming company reporting to include non-financial reporting, and I'll spend most of my time on non-financial reporting. And second, instead of investors and shareholders, one talks now, especially in English-speaking countries, about stakeholders, those plus employees, customers, suppliers, and indeed the society at large. And so it's a much broader focus than it used to be, and this certainly affects the scope of financial reporting. Company reporting is probably the better term. So getting into the presentation, talking about the future of the IASB, a number of points. One can talk the whole time about the future of the IASB and the future trajectory of its projects. The IASB has completed most of its major projects: share-based payment, which was a great success, business combinations, consolidated statements, financial instruments, revenue recognition, and leases, the most recent to come out, IFRS 16. Two major projects are almost complete: insurance contracts and the conceptual framework, and they are expected to be finished next year. And so by then, all the major projects will be behind them, all the ones they can see, at least from this vantage point. Most of the remaining work will be annual improvements and maintenance, chiefly arising from post-implementation reviews. The chairman of the IASB, Hans Hocherforst, has said that the theme of his second term, which just began, the second five-year term, is to achieve better communication, expressing the financial results and the non-financial results more clearly through financial reporting. Now, a question that I raise is, has this lower profile of program of work discouraged applicants for board membership? The initial board was composed of 14 members, and then about 4 or 5 years ago, the oversight trustees decided to increase it to 16, and recently they decided again to drop it to a steady state of 13, but they're at 12. They have never been as small as they are. On July 1st, 2016, following 2 retirements, the board membership dropped to 12 for the first time, and the IFRS Foundation trustees have appealed for applications. They're still waiting, and they're still processing some. One member who was set to retire last June 30th postponed his retirement to the end of this month. When he retires, it'll be down to 11. And I've checked only in the last couple days, and there will be no announcement of new members between now and then, so they'll be down to 11. Now, one thing that has not yet been mentioned by the trustees, but I gather it is in the offing, it's going to be, is that the majority that is required to approve exposure draft standards and interpretations has increased from a simple majority to 1 plus a simple majority, and quietly, without any announcement yet, 2 plus a simple majority. Initially, it was a simple majority, 14-member board, 8-6. In 2005, the trustees, I think as a result of some lobbying by companies in Europe that were trying to slow down the board, persuaded them to say it should be 1 above a simple majority, not quite so easy to pass standards. So instead of 8-6, it was 9-5. They've kept that 9, but the number is now down to 12. Even when it's in the steady state of 13, 9 is 2 above a simple majority of 7-6, 8-5, 9-4. I understand they're going to be making an announcement fairly soon. The trustees met only last week, and sooner or later they will say that the threshold for approving standards and exposure drafts has gone up. Since 2001, the board membership has gone from strong technical backgrounds. Initially, most of the members were ex-national or international standard setters. Of course, back then there were national standard setters setting standards. Now the U.S. is just about the last major one that is doing it, though to some extent Japan is doing it as well, to more pragmatic thinkers. And nowadays they have 5 of the 12 members are ex-regulators. 4 of the 12 are ex-preparers, that is to say with companies, and 2 of the board's 3 users have retired. So they're there with only 1 user, but a very good person, a former leading financial analyst who is near the end of his 10-year term, and nobody knows who is going to replace him. It's very hard to get users. It's very hard to persuade them to give up what could be a very high salary to come to the IASB, which has good salaries, but not as high as they were making. And I think what may be happening is there are a lot of potential candidates out there who, in the absence of a prospect of major projects, feel they don't want to take a major cut in their compensation to join the IASB at that time. That's my speculation. But they're having trouble recruiting, and they've never had trouble recruiting before. Thus far, some 25,000 listed companies around the world use IFRS. Just over half of all listed companies, about 48,000 on major securities markets around the world. The only major holdouts among mandatory adopters being the United States, Japan, India, and China. China has gone most of the way, converging most of the way, but has not gone any further. And nobody can tell China what to do. China goes just as far as they're willing to go. My guess is that if the United States were to adopt, China might decide to adopt, but nobody knows. Interestingly, of those 25,000, 8,000 are the number of listed companies in Europe, which is one reason why Europe is so influential in the deliberations of the board. Many people are upset in Asia, Oceania that Europe is so important, but actually a third of all listed companies are there, and proximity is in their favor as well, because Brussels, where the European Commission is an easy 1 hour flight from London. And so that becomes an issue. You might be interested in realizing how the geographical mix has changed over the last 15 years. Initially, there were 6 from North America, including 5 Americans, 5 from Europe, and 2 in Asia, Oceania, Japan and Australia. Now, 6 has become 2. There are 2 Americans, 4 from Europe, and there are 4 from Asia, Oceania, which is Japan and China and South Korea and now New Zealand, Sue Lloyd, plus a member from Brazil and 1 from South Africa. So there has been a shift from North America to the Asia-Oceanian area. With respect to Japan, more than 140 Japanese companies, accounting for almost 30% of the Tokyo Stock Exchange's market capitalization, have voluntarily adopted or said they plan to adopt full IFRS. Now, Japan is an interesting case. They were about to adopt in a mandatory fashion just when the Americans said in 2008 they were about to adopt. But when the Americans pulled back, mainly because of the influence of the financial crisis and other factors, the Japanese decided to pull back as well. They tend to follow the Americans and have done so since the Second World War, at least on accounting matters. And so at the moment, unlike the Americans who do not allow the voluntary adoption of IFRS by domestic companies, the Japanese do. And beginning in 2010, the Financial Services Agency, the regulatory body in Japan, invited companies to adopt voluntarily IFRS. Well, they were given a little bit of a nudge because, interestingly, the Liberal Democratic Party, which is the party of the government in Japan, in 2012 announced that they would like to see more companies adopt IFRS. It's interesting. It's the first political party I know that has something to say publicly about IFRS. And they said at that time, 4 years ago, that by the end of this year, they would like to see at least 300 companies adopt. So there is some pressure from not from the government itself, but from the party of the government to move further. And that accounts for probably as many large Japanese companies that have adopted. On the U.S. scene, there is absolutely no momentum in that direction. And it will be some time, I think, before the SEC seriously considers it for a whole host of reasons. And if you want to ask about some of those, I'll be glad to respond. But there is no movement whatsoever in the United States, and there's no likelihood in the foreseeable future that they will go ahead. Of course, there are some 500 foreign-listed companies in the United States that use IFRS and which the SEC oversees. So they already oversee IFRS as well as US GAAP. Most of them are Canadian. Worldwide financial reporting comparability has come a long way, we tend to forget, prior to 2005 when each country used its own GAAP. And then, of course, it was devilishly difficult to compare financial statements across countries. So as much as we would like perfection, which we'll never get in worldwide comparability, we're far better off than we were before 2005. Yet the 28 EU countries, and this is a point that's seldom discussed, Hong Kong and South Korea still do not require their companies and auditors to affirm compliance with IFRS, that as issued by the IASB. Instead, in Europe, the EU countries are required by law to say IFRS as adopted by the EU. How does an investor in Sydney or Hong Kong who doesn't study the area carefully know that that happens to be identical to IFRS as issued by the IASB. And so it is not telling the world that you're using the world-class standard. In Hong Kong, it's Hong Kong Financial Reporting Standards, and in Korea, it's Korean IFRS, required by law, by statute law. Now, New Zealanders shouldn't get too smug about this. Between 2005 and 2007, when you adopted it as the mandatory GAAP, auditors and companies were required by law to affirm compliance with New Zealand accounting standards or Australian accounting standards in Australia, but didn't have to say anything about IFRS unless the company asked them to do, or the company did voluntarily, which few did. Then it was realized that it was important to say this to the whole world and not just to people in their own country. And it was decided in both countries in 2007, I think it's FRS 44 that requires it right now, to say in addition to the required affirmation to national standards in accordance with international financial reporting standards. So that change occurred in the year in which you adopted it mandatorily, but you allowed companies to adopt voluntarily as early as 2005. Now, the IASB and the IFRS Foundation will now need to work with regulators and audit firms to assure compliance with IFRS. Now that the major projects are out, the major work has been done in setting the standards, the next question is, how will they be implemented in the respective countries around the world? Well, there are two parties who deal with that. One is the audit firm, and the other is the regulator, the securities market regulator. There are two international bodies that pay attention to this. One is called the International Organization of Securities Commissions, a federation of securities market regulators, such as the FMA in New Zealand, whose chairman at the moment happens to be an Aussie, Greg Medcraft, who is the chair of ASEC. And at one time, Jane Diplock, an Aussie who was chair of your securities regulator, when it was called the Securities Commission, shortly after the turn of the century, was also chair of IASCO for a number of years, and in the EU, the European Securities and Markets Authority. Even in the EU, the quality of securing compliance with IFRS varies sometimes considerably from country to country, to say nothing of countries around the world outside the EU. And so the question is trying to raise the bar. The problem is one of budget, of authority, of training of all the people, and of course the culture. One thing we tend to forget is that there are different accounting cultures, different auditing cultures, different regulatory cultures around the world, different tax systems, income tax systems that provides incentives or disincentives to engage in transactions in certain ways, and this changes the mix of the context of activities. So for example, in Germany, prior to 2005, national GAAP was closely tied to the determination of the income which was the basis for income taxation. Consequently, everybody was very conservative. Companies did not want to pay more tax than necessary. So their financial reporting was itself conservative because it was also used for taxes. Well, now that's not the case. IFRS has nothing to do with taxes, but still the current generation of chief executive officers, chief financial officers, chief accountants come from a period when they think in terms of a conservative result, and it will probably take a generation until Germany stops thinking of net income or profit for the year being a conservative estimate because income taxes are important. And so there are different accounting cultures. There are different auditing cultures. In some countries, the partners and the audit firms come from a somewhat lower social class than the executives do, and it is considered inappropriate for them publicly to rebuff a chief executive officer, members of the board of directors, and so they're reluctant to do it publicly. Instead, they prefer to do it quietly and behind the scenes. In a country like the Netherlands, this used to be true. In the 1990s, audit firm partners would tell me they could see annual financial statements that were in violation not just of private sector standards in the Netherlands, but against the law. And still the auditor didn't give a qualified report because the Netherlands is a consensual country and they don't like public rebuffing of other people, especially very important people in society. So there are different auditing cultures, and as I say, regulatory cultures. The SEC in the United States is a very strong regulator using very strong tools. Other countries don't want something like the SEC. They consider it too oppressive. They don't want orders coming from on high, and so there are different regulatory cultures. Then there is a body that is not as well known, the International Forum of Independent Audit Regulators, which the FMA also belongs to, and ASEC in Australia, which tries to bring together, periodically they do in an annual meeting, the organizations in each country that oversee the conduct of the audits of public companies, that is to say, ones that are listed. In the United States, it's the Public Company Accounting Oversight Board that was created by the Sarbanes-Oxley Act in the wake of the Enron scandal. And so they all come together and compare notes and generally learn from each other's experience and try to raise the bar of performance around the world in national bodies. Despite the fact that the securities market has been global for a long time, securities market regulation is national. There is no cross-border regulation of securities market, of financial reporting. All securities market work is done at the national level. And auditors are, of course, members of national bodies of auditors. These bodies, however, the ones shown in A and B, can do no more than cajole regulators and audit firms to improve their standard of work. They have no control over what they do. Whoops. There we are. Now let's talk a bit about the future of financial reporting, also an interesting issue. And what I'll try to do is to paint a fairly broad picture, because we could spend hours discussing this, and many people in this audience have some experience in some of these changes that are going on. A major financial reporting issue around the world among regulators and the IASB is the proliferation of non-GAAP, or as they say in Australia, non-IFRS measures. The FMA has issued a guidance statement on this in 2012. ASEC issued one the year before. IASCO recently issued one itself. The SEC has stated what they think ought to be done. To give you an idea of how widespread it is, I have some figures. A leading U.S. securities analyst reports that 80% of Standard & Poor's 500 companies reported non-GAAP net income, earnings, profit, in 2015 compared with only 54% in 2009. For 380 U.S. companies last year, GAAP net income fell by 10%, but non-GAAP net income increased by 6.6%. You can see what they are doing is adding back charges. They are not subtracting revenue. These tend to be mostly non-cash charges. And I'll give you an itemization of some of the more common ones in a moment. In a 2016 survey of 270 larger listed companies from 16 countries, including Australia, KPMG found that 54% used non-GAAP measures. So these are widespread, and the regulators are concerned. Of course, these are typically not within the audited financial statements. They're outside the audited financial statements. They might be in separate publications like earnings releases altogether. The U.S. Securities and Exchange Commission insists that non-GAAP figures be reconciled to GAAP equivalents and that both be given equal prominence. And these are generally the views expressed by all who have spoken out on the subject. One issue that we face in the United States, and I don't know if you face it elsewhere because we have a Bill of Rights attached to our Constitution, one of which talks about freedom of speech, is that companies contend in the face of the concern expressed by the SEC that these non-GAAP figures are being espoused, is that's an exercise of free speech. And they have a right to engage in their free speech beyond the audited financial statements. And so there's a bit of a battle in the United States between what the SEC would like to see, which is sticking to the audited financial statements in information given to shareholders and investors, and the exercise of free speech by companies. This may not be an issue elsewhere, as I say. There are many variations of non-GAAP reporting, making most of the non-GAAP figures non-comparable across companies, except I have heard from securities analysts that as long as they are reconciled to the GAAP figures, they can sort them out, and they're not concerned about the fact that they may be non-comparable as they're reported between companies. But nonetheless, the regulators are. The most frequent add-backs to GAAP net income are depreciation, amortization, impairment losses, restructuring charges, equity-based compensation, and the cost of legal settlements. And there are others, but these are very frequent add-backs, almost all being expenses. Regulators are proposing to require companies to be clear about how they derive and present non-GAAP measures, but they apparently may not be able to go much further than that. As I say, both the FMA and ASEC have issued this information, bottom there. Now, what about moves to rid GAAP? Or let's see if I have this right here. There we are. Moves to rid GAAP, or IFRS, of redundant or unnecessary disclosures in financial reporting. Several years ago, your institute cooperated with the Scottish Institute in publishing a study that outlined at some length the disclosures that were redundant and unnecessary. Nobody's really acted on that, and it's been very slow in coming. Why? Because financial analysts do not want to lose any of the disclosures they now have. And so they're battling the regulators the regulators are hearing it from companies saying we are being, a cost is being imposed on us that's excessive in putting out all these disclosures. Shareholders are confused, but the financial analysts don't want to lose any of the disclosures they get now. Some of the information about length of reports, annual reports, may interest you. In the late 1980s, some 30 U.S. corporations experimented with summary annual reports, as they call them, abbreviated reports which accompanied the full annual report. That's over 30 years ago. But the experiment was short-lived. It was led by General Motors and led by Haskins and Sells, which is now part of Deloitte. They tried, but apparently it failed to last very long. Both the IASB and the SEC are looking to pare back the number and complexity of required disclosures, and they have been doing it for some time without any action so far. So it's been a very slow process. A recent study found that the median text length of the SEC's 10K annual report form had more than doubled from 23,000 words 20 years ago to 49,000 words in 2016, with the length of every section of the 10K increasing substantially. Now, 49,000 words is about the length of F. Scott Fitzgerald, The Great Gatsby. That's what these look like. This might interest you. HSBC has the record. Their 2013 annual report to shareholders ran to 594 pages. Banks tend to have very long annual reports. In South Africa, in the UK, twice its length in 2003, to the point that UK Royal Mail had to limit the number which its postmen could carry in their red satchels to prevent back injuries. They spoke out on this, and it was reported in the press. Now, quarterly reporting. Quarterly reporting is not an issue in New Zealand and Australia because it's not required, but it is in other parts of the world. Until recently, it was required, a kind of quarterly management report in the EU. But in 2013, the EU issued a revised transparency directive which abolished the requirement that listed companies publish quarterly interim management reports or statements to diminish the emphasis on short-termism. Putting a lot of emphasis on just the short term as opposed to the longer term. In 2014, the UK's Financial Conduct Authority, 1 year ahead of the deadline for acting on the Transparency Directive, dropped its requirement for such quarterly reporting. So therefore, it is no longer required in the EU, and including, of course, the UK. Without the requirement, some EU companies will nonetheless continue issuing quarterly reports voluntarily. Voluntarily in inverted commas, because a number of them are traded in the United States and the SEC requires quarterly reports, so therefore they still have to produce quarterly reports. Singapore is considering abolishing quarterly reporting. Hong Kong thought about it a couple times and finally dropped the idea. China, Japan, and South Korea also require quarterly reporting. The SEC is giving thought to dispensing with quarterly reports, but is unlikely to do so. Whoops. There we are. The SEC is giving thought to dispensing with quarterly reports, but is unlikely to do so. Now, going further than quarterly reports, looking back, there were two major reports from the 1970s, one American and one British, that were far-seeing about the desirable future trends in financial reporting. One was called the Trueblood Report on the Objectives of Financial Statements, published in 1973 by the American Institute of Certified Public Accountants, and the other was the Corporate Report, published in 1975 by the Accounting Standards Steering Committee in the UK, their standard setter. And they both were, as I say, far-seeing reports. These are right here. Trueblood, the American report, famously argued for providing financial statements that enable investors to predict, compare, and evaluate the amount and timing of potential cash flows. This may seem obvious today, but it was radical thinking in 1973. All subsequent conceptual frameworks developed by all of the standard setters who have done so include this thinking in their conceptual frameworks. So the IASB does, the FASB does. It all originated with this committee of the American Institute of CPAs in 1973. But Trueblood also proposed that companies include financial forecasts with their annual financial statements and report on corporate social responsibility. Something I'll talk about a little bit later on is that the report also suggested that we stop publishing figures as if there is only one single figure that we can come up with for, say, net earnings, when everybody in accounting knows that it is a figure within a possible range of figures depending upon estimates, judgments, and what options that you use that are available to you. And that we ought to say more about ranges and probability distributions and not present figures, as academics would say, as if they were deterministic. There's only one possible right answer, and that is the right answer. And this might make it easier for us to deal with some of these subjective problems in accounting. The corporate report recommended a statement of value added, a statement of future prospects showing likely profit, employment, and investment levels, and a statement of corporate objectives setting out management policy and medium-term strategic targets. This was a far-seeing report, both of them were. Oops, where do we go? Now, the rise of narrative reporting to accompany annual financial statements, the non-financial reporting I talked about before, which I call focused reporting. We all know about the director's report that's been around for a long time, which you inherited from the UK. The director's report, which originated with the British Companies Act of 1948, calls for an appreciation of the state of the company's affairs by its members, with change during the financial year in the nature of the company's business. So that was called for a long time ago. In the United States, in 1968, the Securities and Exchange Commission began calling for management's discussion and analysis of operations, an unaudited narrative explanation of the company's operations and future prospects, the risks and uncertainties management faces, and it's to complement the financial statements, provide a kind of context for the financial statements. And some of these can go on for 30, 40, and 50 pages accompanying the annual report. And the SEC looks at them very carefully to be satisfied that they are sufficiently forthcoming. In 1993 and again in 2002, the UK's Accounting Standards Board issued guidance for an operating and financial review, very much like the MD&A. In 1998, the Australian Stock Exchange began requiring listed companies to provide what they called a review of operations and financial conditions. So you begin to see the regulators becoming active here and the standard setters. In 2001, the Australian Corporations Act called for information that shareholders would reasonably require to make an informed assessment of the business strategies and prospects for future financial years. And in 2013, only 3 years ago, ASIC issued guidance for an operating and financial review. And in 2010, IASB issued a non-binding practice statement, management commentary, calling for forward-looking information, with the New Zealand's Financial Reporting Standards Board playing a leadership role in assisting the IASB in developing that management commentary. But it's non-binding. It's the only such non-binding practice statement the IASB issued. Now, this may be an interesting development. Just 3 years ago, the UK government began requiring a strategic report. As far as I can tell, this originated in the Liberal Democrat Conservative coalition that at that time was running Britain, and they felt this was very important as a part of improving the information in the securities markets. And the object is to inform shareholders and help them assess how the directors have performed their duty to promote the success of the company, to describe the company's strategy, objectives, and business model. Just last month, PwC put out a review of 350 FTSE companies, the stock exchange listed companies in the UK, to see to what extent they have met with the spirit and the letter of the recommendation, that is to say, of the Act. And they found that there was very little strategy in the strategic reports. They said that although the position is better than it was 3 years ago, strategy is often not fully integrated throughout the majority of reports. Only 37% of the FTSE 500 implicitly or explicitly base their reporting on strategic themes. This leaves a staggering 63% of the FTSE 350 failing to feature strategy in their strategic report in an obvious and meaningful way. So they were considerably disappointed with the quality of the work. Sometimes if something is imposed, companies will just do what's required, but if they go out and volunteer to do something, they're much more forthcoming in what they do. Integrated reporting, of course, is a very important movement. The International Integrated Reporting Council is a global coalition founded in 2011. It's been around only 5 years to promote company reporting about value creation for shareholders, for investors, for employees, for customers. Since 2010, thanks to a real leader in South Africa, the Johannesburg Stock Exchange has required listed companies to publish an integrated report with emphasis on sustainability. That's the one country that now requires it. There have been some developments in New Zealand. In 2013, the New Zealand Post Group became the first New Zealand company to publish an integrated report of 41 pages as volume 1 in its annual report. But such reporting has not yet taken hold in New Zealand. There are a few examples. Spark New Zealand, I know we have a couple of people here from Spark, in 2016 experimented with 2 novel integrated annual reports. And while it's not on my slide, Sanford, the seafood company, starting in 2014, has done an impressive job, I think, of developing an integrated report. In the United States, last March, General Electric, known for progressive financial reporting, issued a 65-page integrated summary report, which surprised everybody, and it was widely noticed. The U.S. environment is very hostile to innovation because of the high incidence of litigation. Companies are concerned about going further than what the law requires for fear lawsuits will be brought against them alleging that they are engaging in false and misleading information according to our securities laws. So they're very reluctant to go further than what the law requires. And so General Electric's initiative here was widely noticed. I asked somebody in General Electric if they cleared it with the SEC first, and the answer was yes. They passed it by the SEC, and the SEC said, go ahead. But it has not been imitated by anybody else yet. In its 2016 survey of business reporting, KPMG found that the section of the annual report devoted to the company's strategy and business model was only slightly more than a third of the space devoted to the financial statements. Now, value-added reporting, one of the suggestions of the corporate report. Accountability to a wider array of stakeholders. It shows the value added, essentially saying where has been the value creation, who has benefited by providers of capital, including, of course, creditors, employees, and government. It was widely practiced by companies in the UK in the late 1970s. About a fifth of major listed companies in 1977-78 published value-added statements voluntarily. In Singapore in the 1980s, in South Africa in the 1990s, and is now required of listed companies in Brazil. I will say something, if you ask me, as to why in the UK it was practiced in the late 70s. It was because of the political environment, the very left-leaning Labour government that worried everybody about the future of the economy and the political system. And I think there was a feeling that they ought to show how accounting contributes to society. Now, displaying financial forecasts as part of the financial statements, KPMG, in its 2016 worldwide study of 270 companies, which I've already mentioned, found that 25% provided short-term forecasts in their annual report. German companies issuing consolidated statements are expected by national law to provide a qualitative comparative financial forecast over a one-year horizon in their annual report. So there has been some development in this area. Now, the final point I'd like to cover, which I think is a very important one and something that we can all relate to, is a more informative reporting of companies' intangible assets. We are now in a post-industrial society. In the 40s, 50s, 60s, most of the assets were manufacturing enterprises, buildings, equipment, machinery, merchandise inventories, goodwill, other intangibles, relatively small portion of the assets when acquisitions occurred. But here are a couple examples about the magnitude these days. In eBay's 2005 acquisition of Skype Technologies, 99% of the purchase price of $2.6 billion was assigned to intangible assets, of which goodwill was 90%. But it isn't limited to high-tech companies. Look at Johnson & Johnson, which is America's and I think the world's largest pharmaceutical company. In Johnson & Johnson's 2007 acquisition of Pfizer Consumer Healthcare, 92% of the purchase price of $16.6 billion was assigned to intangible assets and goodwill, of which 39% was goodwill. In 2009, KPMG found that in a study of 342 acquisitions between 2003 and 2007 in 14 industries, the median percentage of the purchase price assigned to goodwill varied by industry from 36 to 70%, the majority of the industries being 50%, the median. In the same study, the median percentage of the purchase price assigned to intangible assets other than goodwill varied by industry from 6% to 57%, with the majority of the industries being over 30%. So you can see these are considerable. These are not immaterial items. Under IFRS, IAS 38 stipulates that all R, research, and most D, development, are expensed. Under US GAAP, all R and D are expensed. And for so many balance sheets today, the amounts assigned to internally developed patents in balance sheets are minuscule, but they are the lifeblood of many corporations. For high-tech and service companies, intellectual capital is probably their largest asset. Now, intellectual capital consists of, according to the Danish Ministry of Science, Technology, and Innovation, which has done a lot of work in this area together with Danish academics, consists of human capital, structural capital, which is mainly patents, and relational capital, such as customer lists. And this is something which largely does not appear in financial statements. It appears only when it is purchased and not when it is developed internally. Also, brands are another one. Take, for example, Apple. In the United States, Forbes magazine and Businessweek every year publishes the most valuable brands in the world. And of course, they differ significantly. These are very broad estimates. Apple's brand is valued at $154 billion, which is 81% of the total assets shown in Apple's annual report. Google's Alphabet is $83 billion, which is 64% of the assets reflected in their annual report, and Microsoft's $75 billion is 43%. Large, significant assets are left out, as are the value of customer lists and customer relations and intellectual capital. Now, I'm not suggesting that we put these in the main financial statements. There could well be supplementary disclosure, supplementary statements that provide some information that is maybe subject to a lower level of recognition for accounting purposes than what we put in the balance sheet and the income statement. Denmark, as I've suggested, has made progress in the preparation of intellectual capital statements, mostly for internal use, but also for external reporting, because the Danish Financial Statements Act of 2001 requires that companies in Denmark provide supplementary disclosure of the value of intellectual assets if they are likely to affect future earnings. The only country that, as far as I know, requires any kind of public reporting about intellectual capital. The maxim that is important here is that you manage what you measure. And if you don't measure something, you may not manage it. We discovered this in the United States in the early 1990s when the FASB issued its Statement 106 on other post-retirement benefits, including health care, which no companies were recording at all. They were simply giving them or agreeing to collective bargaining in which they gave them, and they weren't managing them. They weren't paying attention to how much they'd given. They hadn't costed them out until the standard came out and required them to show as a liability the present value of the future expected payments under these agreements, and all of a sudden companies began looking much more carefully at the cost of the health care benefits they had given out, and the term thus, you manage what you measure. In its 2016 survey of business reporting, KPMG found that only 22% provided performance information related to intellectual capital that went beyond a disclosure of expenditures, like for training. My guess is that most of what we record as goodwill upon acquisition can be classified as intellectual capital, but we don't report it as such. We just call it goodwill, that amorphous goodwill. Once again, talking about point estimates and determinative figures, if we allowed ourselves to talk about ranges, saying that the expected value of brands might fall between these two, that is useful information. It doesn't have to be a point estimate. Nobody knows what the point estimate is for the value of any company's brands or customer lists or intellectual capital, and that prevents us from being innovative with respect to some kind of useful reporting to outsiders. Now, what might happen in the United States? Just in August, the FASB's Advisory Council, which meets quarterly with the FASB, indicated a top priority for the board to revisit the accounting recognition or disclosure of internally generated intangibles. And so therefore it is expected this will appear on the agenda of the FASB. Intangibles are a significant part of many companies' business models, but are rarely seen in their financial statements when not purchased. I think this is a big gap, and there are many people who do. Let me just close by mentioning, way back in 1996, 20 years ago, the very cautious and conservative SEC decided to hold a 2-day symposium on reporting companies' internally developed intangibles. Now, if a body like the SEC that's so cautious and conservative, that is in charge of implementing acts that impose huge burdens of potential liability in companies for misstating or possibly allegedly misleading readers of financial statements, says that 2 days ought to be devoted to this, and they brought in Danish and Swedish sources who had been pioneering in the disclosure of the estimated values of customer lists and intangible capital. It seems to me the others might take notice. Very unlikely the SEC would do this, but 20 years ago it did. Thank you very much.